what's up? Red Panda Anthem. Red Panda, what's good?
So let's get into this. I want to start with probably the biggest thing that happened last week is Amazon.
Mm-hmm.
So Amazon, it was down 20% after hours, but then it rebounded. I think it finished the day down like 7%, something like that.
Mm-hmm.
But missed its expected guidance. The guidance was lower than expected.
Mm-hmm.
Still profitable, still made a ton of money, but just missed Wall Street's expectations. And it dropped to a 52-week low. Like I said, rebounded a little bit from that. But yeah, it's interesting, man. It really, had a really tough day, and it's been having a tough year.
Yeah.
It's been having a tough couple years, actually. So now the stock market.
Are we going to get the dialogue and debate that we get around sports?
Well,
sports debate show is going to be the one.
The sports debate show is so the stock market is up for the month of October.
Yeah, Dow's up 11%.
The NASDAQ is up. Even the other day when Amazon crashed, NASDAQ was up, S&P was up, Dow was up. But so Amazon was your pick of the year.
Yes, it was.
So I'll let you start off this conversation. Do you want to reverse that?
I'm not going to say up Everest or down Everest. Yeah. So which way are we going? Ascension. Which way are we going? Yes. Ascension or descension is key. Yeah, I mean, based on everything that I had read in my information, I stuck by that pick. Has it gone the way I predicted? No. Do I still believe in the company? Absolutely. The report, the earnings report was interesting, right? Because there was some, like, if you looked inside of it, there was some good spots, but the bad spots were so bad that it got overlooked. So I'm gonna break it down by the numbers. And so a good spot, the revenue grew by 15%. Anytime you have a business and it grows, that's great. The advertising, right, which is we said was going to pass Google at some point, was up by 25%. The big pitfall was the operating income. That fell by 49%. Right.
For those who don't know what operating income is, can you really quickly explain to them what that is?
I think the best way to say it is the money that they are taking in and how they're going to use it. Now, specifically for tech companies in inflationary environments, this does not bode well, right? And so as inflation goes, the cost to do things, to operate your business obviously goes up. And so when you see interest rate rise, you see, right, since January, if you look at the NASDAQ, the tech stocks have taken descension. We're going to stick with that word.
Most people died riding down Everest or walking down Everest, right?
Most counts die on a descension. Yes. So that was huge, right? The earnings per share dropped, right, by an estimated 45%. So those two things, when you're talking about operating costs and the earnings per share dropping, there you can see why a company like Amazon, which I still think is a top 3, if not top 2 companies in the world, has such a negative quarter. The operating cash flow also declined by 25%. So we're talking about 3 major factors of things that are like, all right, this is a rough quarter. But even Bezos, when they asked him about it, he was like, look, we're going to have to really tighten the belt because the climate's about to get a little tricky. So those are 3 factors. You add on to it one other thing that was almost positive and kind of got overlooked, but the fourth quarter revenue is expected to grow by 2 to 8%. Fourth quarter, obviously, we know is holiday shopping, holiday season. More people are in e-commerce. The only thing is that what they're seeing is that more people are going back into the stores. We thought that obviously from the COVID time that people were shopping online and it was a positive, but people are back outside, right? E-commerce numbers are not looking the same as they did when, it was a lockdown. So all those things taken into account, I understand it. Do I still believe in it? Absolutely. Is it going to be the stock of the year? Absolutely not. It's still one of my top 2 or 3 companies, though.
The big thing I want people to realize is that even in a company when it's going down, if you wait for a great price to get in, everyone in Stock Club, please put in chat what was the number I'll call for Amazon. You can still make money on a heavy drop like that. So the fundamentals of the company haven't changed that much. Their global market share dominance has not changed that much. When you have interest rates, of course, going up. And we're now going through, I think this ultimately will be a bigger recession when it's all said and done than 2007, 2008. But Amazon is primed, no pun intended, to do really well once things start to settle out. They could be a hell of a lot lower being in that tech space. They haven't fallen to the 70s or the 60s. 99 was like a good spot that we liked, got in. It's like currently like a 104. If you're holding it for the long term, you'll be good. Also, for a quick homework assignment, internationally, if you're going to order online from someone, who are the 4 biggest competitors of Amazon? Now, ask yourself, who's going to get the goods to you there faster than Amazon? No one. They'll fix the operating income. Any money that they're losing right now, they'll fix going into next year. You're going to be really upset if you don't hold the stock through 2025, 2026.
Yeah. And if you look at the climate of the world, like every country is trying to create a business that replicates Amazon. Right. And I won't give them the names because you gave them the homework assignment, but go look in China. Right. Well, we know that company, but go look in South America. There's another company there that has duplicated the business model of Amazon. And so they'll figure it out. I believe in it.
Well, let me ask you this, Ian. You said a few times that your theory of 2 tech, 2 index, if inflation gets, I think, to over 11%, then that, right? 11%?
Yes.
Then that is going to hurt your theory. So why is high inflation bad for technology?
Especially when quantitative easing goes away, all the easy wins, like for all my hoopers, like when we play on like a 9-foot rim, we all look like LeBron. 10 feet, dramatically different. So that difference between having 0 interest rates and being able to borrow money, like imagine if I said, hey, come to InvestFast Euro, we'll give every entrepreneur $100,000 and you never have to pay us back. The upside for the entrepreneur is probably a 95% win rate. If we give 100,000 pounds away and say, hey, you got to pay us 25% back, now maybe only 30% of the businesses will actually be profitable as a result. So that arbitrage is one of the biggest reasons. Now, Apple, inside of that 2 tech, 2 index model, has worked well. That's why I always say pair with the top 2. But if you're going through tech and you're looking at something that's 15th or 20th, it's not going to do really well, because what the technology industry really has done has gotten venture capital, which has funded all of the ideas. And we haven't funded innovation. We've really funded the ideas that can get funded. That's why we have a whole bunch of social media apps. We could talk about it later. Now, Jack from Square is looking to make another social media app, which I think is a mistake. But you're really playing an interest rate arbitrage game. So if I'm getting loan money at 3%, when I can find a way ultimately to sell advertising or a subscription to my user base at 9%, I'm playing an arbitrage game and getting the profit in between. If interest rates is high and no one's loaning the money out, it's really hard to win that game. So we are in a space where we need more innovation. And ironically enough, tech has not done a great job at making a bunch of innovation how we thought. Like when we were kids, I thought we would have flying cars by now.
Yeah, Jetsons for sure.
We're not there. Like Ray J's the only one still making scooty bikes.
Shout out to
City. Shout out to Ray J.
Legend.
So we need more innovation. And I think now we're just going to clear the way for people to be able to get out all the bad companies and create companies that will actually have a real impact.
All right. Fair enough. So let's talk about this. How are you able to predict the fall of Meta?
Can we get the horns? So 3 things. This is normally the moment where I would like pat myself on the back, but I want this to be a very instructional lesson. Number 1, you always have to understand what the macroeconomic environment is. So if the economy, if the entire world is thinking things are going well, you have to dig and do the research and say what is wrong with the industry or the cycle that we're in. Because it's easy in 2020, 2021, everyone just to throw money into options, Forex, venture capital, angel, and think they're a genius. But you have to see when is the Fed going to stop funding this big bubble that they created. Number 2, if you look at the hiring spree that Facebook went on, it's unsustainable. A couple of times I've been to Meta's offices, they have some of the brightest people in the world, but if I'm looking at the balance sheet, They have hired more people than Apple and Google with an inferior product in comparison. That's a recipe for disaster. Number 3, that date in which, so I calculated if, and this is a homework assignment for everyone, if we stay without quantitative easing for the next 5 years, what are the top 2 industries that will do well and which companies in tech will be hurt by it? Advertising is a really thin margins game. And I was in it before. It's part of the reason I got out. If you make a company $200 million and they won't even allow you to get 10% of it, which most ad agencies don't, on the tech side, how much money is Meta making if Ford makes $2 billion in a year off of sales? It's a horrible business model. If we walked right now into GM and increased their sales by $3 billion in 1 year, how much money should we get? I'm minimum going to ask that we get 25%. So I think the business model is broken. And then lastly, if you look at the FANG revolution, when that started, everyone in that FANG category ended up being better. The biggest issue in terms of leadership, and you talk about this a lot, Zuckerberg won't listen to anyone on his team in terms of how they should pivot. I really think they should have let Sandberg run Facebook. He should have ran AR and VR, and they should have bought Square or partnered with Square to do the payment and crypto side. But that would take all the control out of his hands. So when I'm looking at leadership, even though Tim Cook is a tough CEO, Steve was a tough CEO, if you had a great idea, he will listen. As crazy as me and 19 can be when we have ideas, you guys listen. Zuckerberg hasn't listened to his team or employee base in a long time, and that's one of the reasons why most companies fall apart. And that was the final reason that I saw, okay, if he's trying, if we can be very honest, he has to go steal another idea. The first great idea was stolen. Every idea that he created after that were B ideas. And now that you have everyone blocking all of your deals because they don't like him, and Congress is constantly calling him up to speak on behalf of tech and what he's doing to society, that is not a good recipe for disaster. That's why it's really important to be innovative and not to copy, because if now you're not able to copy anyone else's ideas like how you did the Winklevoss twins, you're in trouble. He needs to build a team around him that actually will make some great innovation. He should have bought Tencent, should have bought Square. I can argue he should have bought Roblox. Facebook Marketplace was good. Should have put an offer in to maybe buy some of those other applications that sell. It was just a lot of mistakes made.
This that Red Panda Anthem. Ian, what's up? This that Red Panda Anthem. Red Panda, what's good? Red Panda Anthem. Your boy going up. I know they can't stand it.